All right. Have you ever looked at a massive company and just wondered, what makes it all work? It's definitely not just one person in a fancy office. It's actually a really complex, carefully designed blueprint. So today, that's exactly what we're going to do. We're going to break down that blueprint piece by piece and really get a handle on the structure of power, the rules, and of course, the money that drives every major corporation. Now, if you're planning on a career in business, this isn't just some abstract theory. This is the fundamental architecture you're going to be working in. So, let's dive in.
So let's start with the big question. Who is really running the show? I mean, it seems like it should have a simple answer, right? But the truth is, it's this fascinating web of power and responsibility. This gets right to the heart of what we call the principal-agent problem in corporate finance. And to really get a grasp on how a company functions, we first need to untangle that web and figure out who's actually pulling the strings. And more importantly, whose interests they're supposed to be serving.
Okay, so our first stop is going to take us right inside the boardroom. You can think of this place as the company's nerve center. It's the strategic command post where all the big picture decisions get made and the company's entire future is mapped out. These are the people at the helm, and believe me, understanding their very distinct roles is absolutely critical.
So right at the top of the corporate pyramid, we have the board of directors. Now, it's really important to understand that their job isn't to get bogged down in the day-to-day stuff. No, they're elected by the shareholders, who are the actual owners of the company, to act as fiduciaries. And that word fiduciary is so important here. It means they have a legal and an ethical duty to act in the best interests of the company. This breaks down into two core responsibilities: the duty of care, which means they have to be informed and act prudently, and the duty of loyalty, which means the company's interests have to come before their own. So they're the ones providing that high-level strategic oversight, signing off on major investments, and, this is a big one, hiring and firing the CEO. They really are the architects of the company's long-term vision.
And this slide really nails that crucial division of labor you see in corporate governance. The board is, operating at 30,000 feet, deciding the destination. The officers, we're talking the C-suite, your CEO, your CFO, they're the ones on the ground actually navigating the day-to-day terrain to get the company there. This separation is there for a reason. It's designed to create a system of checks and balances. It helps manage that principal-agent problem we talked about by making sure the agents, who are the management, are held accountable by the representatives of the principals, who are the shareholders. It's a really delicate dance between strategy and execution.
Okay, so with all this power concentrated right at the top, you might be thinking, well, can't the board and the officers just do whatever they feel like? And that's a fair question, but the answer is a hard no. There's another incredibly powerful external force that keeps them in check, and that adds a whole other critical layer to our blueprint.
And that brings us to the regulatory landscape. Now, the best way to think about this is as the official rule book that every single corporation, whether it's a tiny startup or a huge multinational giant, has to play by. And let's be clear, these are not suggestions. These are legally binding rules that shape just about every aspect of how a business operates and how it reports its finances.
And this is not just about some boring bureaucratic red tape. We're talking about massive, landmark pieces of legislation. Think about the Sarbanes-Oxley Act, which came about after the huge accounting scandals at places like Enron and WorldCom to force companies to have strict financial reporting controls. We're talking about OSHA standards that dictate worker safety and EPA regulations that limit pollution. These rules are basically the guardrails that prevent corporate power from just running wild, and they ensure the entire market has integrity.
So, what is the ultimate goal of all these rules? Well, this quote really hits the nail on the head. They exist to build trust. By making sure companies are transparent and fair, regulations protect investors from getting ripped off, they protect employees from being exploited, and they protect the public from harm. For anyone going into accounting or finance, understanding these rules isn't just a good idea, it's the entire foundation for producing financial statements that are reliable, comparable, and actually useful for making decisions. It's truly the bedrock of a healthy market economy.
All right, so we've got the people and we've got the rules. But none of that really matters without the fuel that powers the whole corporate engine. Money. So now we're going to follow the money. Not just the money coming in as revenue, but the money going out as costs, to get a handle on the financial realities that every single company has to deal with.
You see, the cost of doing business is so much more than just what you pay for materials or labor. There are corporate income taxes, which for some companies can be their single biggest expense. Then you've got the millions, sometimes hundreds of millions, spent on armies of lawyers, auditors, and consultants just to make sure you're complying with all those regulations. That's a cost that doesn't make you a single dime in revenue, but is absolutely essential for survival. And then, of course, there's the massive overhead of just running a modern company, what we call SG&A, or Selling, General, and Administrative Expenses, that covers everything from the marketing budget to the IT department.
And these costs, they're not just numbers on an income statement. They have a massive, real-world impact on a company's ability to innovate, to grow, and to compete. You know, a sudden spike in compliance costs can completely change the math on a new project, maybe even killing a potential product launch. A change in the tax code can fundamentally reshape the profitability of an entire industry. Now, as a future decision maker, a really common mistake is to only focus on growing revenue. But let me tell you, understanding and managing this incredibly complex cost structure is absolutely key to understanding corporate strategy and achieving long-term sustainable profit.
So, we've broken down the 3 core components of our corporate blueprint. Now let's take a step back and see how they all fit together to create the complete, dynamic picture of a modern corporation.
And there you have it, the 3 pillars of the modern corporation. You've got management, the decision makers, who provide the vision and the direction. You've got regulation, the rule book that sets the boundaries for what's acceptable. And you've got costs, the financial reality that dictates the constraints the company has to operate within. It's the constant, delicate balancing act between these 3 forces that really determines whether a company succeeds in the long run or fails.
And this brings us to what I think is the central tension at the very heart of modern business. How does a company balance that relentless pressure to create shareholder value with the absolute necessity of following the rules and managing its costs? This is not some theoretical question you'll find in a textbook. It's a real battle fought every single day in every boardroom across the globe. So the next time you're reading a company's 10K report or you see a headline about a corporate scandal, I want you to remember this blueprint. Because chances are the answer to what's going on lies in the complex and often conflicting interplay between these 3 incredibly powerful forces.